Hello students. Now in this video let us start discussing MTP1 applicable for May 2025 attempt direct taxation. See, there are many case studies that are given in MTP for which answers are available, but how those answers came, what is the calculation that is not given by ICI, that I am going to reveal to you. I am going to explain very clearly to you this MTP. Let us start very quickly. First, Manisha is a research scholar pursuing her PhD. She is unmarried and her parents are living in Ahmedabad, Gujarat. Her parental means paternal grandparents and other family relatives are staying in South Africa. She was in India with her parents till May 2020. After then, she went to London for further education. In October 2023, she returned to India. On 28th March 2024, she travelled out of India to Johannesburg in South Africa for her research project and Khadi business exhibitions. She returned on 1st October 24 to participate in the 155th birth anniversary celebrations of Mahatma Gandhi. In this connection, she attended numerous events held all over India. So when she came back, she came back on 1st October 2024. That means in previous year 24-25, how many days she stayed in India? In October, she stayed in India for 31 days. October 31, November 30. Likewise, till March she stayed in India. March 31 days. How many days she stayed in India? October 31, November 30, December 31, Jan 31, February 28, March 31. So, in India, during 24-25, she stayed in India for exactly 182 days. So, when she stays in India for 182 days, she satisfies B1. When she satisfies B1, she becomes resident in India. Am I correct now? In this connection, she attended numerous events held all over India, which while also holding exhibitions for her textile business in Khadi. She won accolades and awards, gifts and donations in the course of showcasing her work. You have been provided with following data in respect of her receipts and income for financial year 24-25. First, let us see the question. List of incomes are given. Then what are the note points? Manisha does not manufacture any of the Khadi products. She sourced all the Khadi materials, accessories, products and honey from suppliers of such items. All financial transactions are carried out in account pay checks. That means entire transactions are done through bank transaction and TDS has been deducted. Her paternal grandfather is the Karta of the family HUF. Her paternal grandfather comes on a visit in India for 6 months every year since 2014. The HUF is managed outside India and all decisions regarding HUF are made outside India. Manisha has opted out of default tax regime. So, first question, what is residential status of HUF? See, in case of HUF, whether HUF is resident or non-resident, that is determined based on control and management affairs. Okay, here all the policy decisions are taken outside India. That means control and management of HUF is outside India. When control and management of HUF is outside India, then HUF will be treated as non-resident. Is it clear? Next, second question. Determine taxability of gift received by Manisha from her father's sister and from her friends in Gandhi Gujarat Seva Samaj for assessment year 25-26. See, she received some gifts, it seems. Look, 6th point and 7th point, gift from father's sister. See, father's sister is a relative. If father's sister is a relative, then gift received from relative is not taxable. Gift received from relative is fully exempt. Next, cash gift received from friends. What is the amount of cash gifts? Amount of cash gifts is less than 50,000. So it is not taxable. So we need to choose the most appropriate answer. First of all, 51,000 is gift received from relative. I think D is the option. You can see 51,000 will be exempt as it is gift received from relative. 27,000 received as cash gift will not be taxable as total gifts does not exceed 50,000 rupees. Are you able to understand? Next. What would be total income of Miss Manisha if she wishes to maximize tax savings? This line is very important. What is the question? If she wishes to maximize tax savings. First of all, let us go through the incomes and let us see what are her incomes. Based on that, let us calculate what is her total income. Okay. Scholarship. Whenever scholarship is received for education or research work, that is not taxable, that is exempt. Gross receipts from exhibitions held in South Africa in collaboration with leading fashion house. First of all, she is resident in India, right? And in last 10 years, before May 2020, she stayed in India. That means what? For 2 years, she is resident in India and she also stayed in India for 730 days. Correct? From May 2022, last 4-5 years, she stayed in India. That means what? Obviously, in all those years, she stayed in India each year for 365 days. So she will satisfy additional conditions also. So her residential status will be ROR. If she is ROR, she is required to pay tax on global income, both Indian income and foreign income. Am I correct? So even foreign income is also taxable for Manisha. So from business, gross receipts are 10 lakhs. Gross receipts from exhibitions held in India, 12 lakhs. Gross receipts means turnover. Gross receipts from sale of honey. Sale of honey is not agricultural income. It is taxable. Okay. Gross receipts from sale of handmade khadi designer fashion accessories and other khadi stationery products. Next, received share of income. Share of income is not taxable. Share of income is exempt. Next, cost of materials for exhibitions held in South Africa. These are nothing but expenses. These are nothing but revenues. These 3 points are revenue. These 3 are expenses. How much are expenses? 12 lakhs, 1 lakh, 4 lakh, 55,000. So total expenditure is 12 lakh plus 1 lakh plus 4 lakh plus 55,000. 17 lakh 55,000 is expenditure. Revenue 10 lakh plus 12 lakh plus 1 lakh 5,000. 23 lakh 5,000 is revenue. Okay. No, you also need to consider 2 lakh 25,000. 23 lakh 5,000 plus 2 lakh 25,000. How much is revenue? Revenue is 25 lakh 30,000. This is turnover. How much are expenses? Expenses are 17 lakh 55,000. So how much is profit? Profit is 7 lakh 75,000. But we can also calculate under 44 AD, right? Because everything is received through bank. Up to 2 crore rupees you can calculate under 44 AD. If you apply 44 AD, 6% of turnover is presumptive income. Am I correct? So 6% of turnover means 25 lakh 30,000 into 6%. How much? 1,51,800. Out of these two, which is beneficial? It is better to disclose 1,51,800 as income. That is the answer. You can check. 1,51,800 is the answer. Next. Mrs. Ritu is a retired government employee. She was born on 1st April 1942 in India. She is residing in Delhi. She stayed with her elder son, Mr. Nakul, from 1st May 2024 to 15th October 2024. who is residing in Australia. So that means what? From 1st May 24 to 15th October 24, she is not in India, she is in Australia. Is it clear? Remaining time she is in India. So in Australia, how many days she is there in Australia? May 31 days, June 30 days, July 31 days, August 31 days, September 30 days, October 15 days. That means what? She stayed in Australia for 168 days. How many days she stayed in India? So she stayed in India. How many days? He stayed in India is equal to 365 minus 168. 197 days she stayed in India. That means more than 182 days. She will satisfy B1. So she becomes resident in India. Is it clear? Are you able to understand? So she stayed in India for 361 days during 4 previous years immediately preceding previous year 24-25. Next, see if nothing is specified means in current previous year she went Australia. Earlier she stayed in India only. In earlier years if she stayed in India, she will satisfy additional conditions. If she satisfies additional conditions, she becomes ROR. Is it clear? So her residential status is ROR. In current year she stayed in India for 197 days, which is greater than 182 days. So she is resident. She also satisfied additional conditions. She becomes ROR. Is it clear? Next, during previous year 24-25, pension of 7,15,461 is credited in her bank account with SBI after deducting TDS. So this amount is net amount, okay, after deduction of TDS. If you want gross amount, you need to add TDS amount as well. She received interest of 4,352 on her savings bank account with SBI during previous year 24-25. She also received interest of 67,500 net of TDS on fixed deposits with Canara Bank in the month of April 2024. This is the information. She has purchased 2 life insurance policies for her son Mr. Yuan and married daughter Mrs. Kajal, the details of which are as follows. Mr. Yuan, when policy was taken 15th October 2020, date of payment of premium 23 October 24, sum assured 9,84,655, premium paid. That means policy is taken after 1st April 2013. So maximum deduction allowed is equal to actual premium or 10% of sum assured, whichever is lower. This is actual premium. 10% of sum assured means 9,84,655 into 10%. So or 98,465. Whichever is lower means 98,465 is allowed as deduction. In second case also, policy was taken after 1st April 2013. That means maximum deduction allowed is equal to actual life insurance premium or 10% of sum assured. 10% of sum assured means 2 lakhs into 10% how much? 20,000. Whichever is lower means 20,000 will be allowed as deduction. Is it clear? Now, she has taken medical insurance for herself for which she paid an amount of 35,000 towards health insurance premium by account pay check. Very good. Here health insurance premium is paid by way of bank transaction. Whenever health insurance premium is paid by way of bank transaction, that is allowed as deduction. Moreover, she is a senior citizen, right? She was born on 1st April 1942. That means her age is greater than 80 years. She can claim deduction under section 80D up to 50,000 rupees. Okay. Next. She incurred preventive health checkup 7,500, but maximum allowed is only 5,000. She also incurred medical expenditure of 25,000 in cash. Whenever medical expenditure is incurred in cash, that is not allowed as deduction. In the month of March 2025, she incurred medical expenditure of 10,500 for herself, which is paid by account payee check. See, medical insurance premium, medical expenditure. Only one is allowed as deduction. As medical insurance premium was paid, medical expenditure is not allowed as deduction. So this 10,500 is not allowed. She has given a wristwatch of 10,000 on her husband's 85th birthday. She is not receiving gift. She is giving the gift. So there is no point of tax. Okay. Her husband is resident in India. Based on the facts of the case scenario given above, choose most appropriate answer. What would be the amount of deduction under chapter 6A? First of all, under 80C, she can claim 98,465 and 20,000. 98,465 plus 20,000. Total how much? 1,18,465. Next, under 80D, what are allowed as deduction? 5,000 and 35,000. Two are allowed. 35,000 plus 5,000. 40,000. Next, see, she is senior citizen and is also resident in India. So for interest income, she can claim deduction up to 50,000 under section 80 TTB. Correct? So under 80 TTB, she can claim 50,000. So overall, how much are chapter 6A deductions? 2,08,465. That means this is the answer. What would be gross total income of Mrs. Ritu for assessment year 25-26 under normal provisions of that? What is being asked? Please look. He asked us to calculate gross total income, not total income. Total income means after claiming chapter 6A deductions. He did not ask us to calculate total income. He asked us to calculate gross total income. Now, how much is gross total income? Pension is taxable under the head salaries, right? Pension is taxable under salaries, but this is net. So how much is gross salary? Gross salary is equal to 7,15,461 plus 14,565. 7,30,026. From this you can claim standard deduction, right? Under normal provisions, standard deduction is 50,000. So how much is net salary? 6,80,026. Good. Next, she received 4,352 from savings account. She also received 67,500 net of TDS. On interest rate of TDS is 10%. That means what? 67,500 divided by 90 into 100, because 67,500 is after deduction of TDS. After deduction of TDS means it is at 90% level. Correct? So 67,500 divided by 90 into 100. How much? 75,000. So how much is her gross total income plus 4352 plus 6,80,026? 7,59,378. Let us see. Yes. What would be total income of Mrs. Ritu for assessment year 25-26 if she pays tax under section 115 BAC? If she is paying taxes under section 115 BAC, standard deduction is not 50,000, standard deduction is 75,000. So in place of 50,000, we will claim 75,000 standard deduction. 7,30,026 minus 75,000. 6,55,026 plus 4352 plus 75,000. 7,34,378. Anyhow, chapter 6 deductions are not allowed under default tax rates. 80C, 80D, 80TTB are not allowed. So 734 378. They rounded it off to 734, 380. That is the answer. Next. Third one. In previous year 24-25, Mr. Arun has transferred following long-term capital assets. So Arun is individual. He transferred following long-term capital assets. Residential house property 8 crores. Cost of acquisition 6 crores. Transfer date 25th November. That means after 23rd July 2024. Jewelry 3 crores. Cost of acquisition 2 crores. Transfer date 5th January 2025. Okay. Mr. Arun. So two capital assets are transferred. One is residential house property. Another one is jewelry. Mr. Arun bought a new residential house property on 1st April 23 for 1 crore and on 28th February 2025 deposited 3 crores in capital gains deposit account scheme. So, see, for residential house property and for jewelry. For residential house property, full value of consideration is 8 crores. Transfer expenses nil. Net consideration is also 8 crores. From that we will claim cost of acquisition. How much is cost of acquisition? 6 crores. So gross capital gain is 2 crores. Got it? So gross capital gain 2 crores. How much he deposited in capital gains account scheme? 3 crores. However, on 1st May 2025, Arun has withdrawn 3 crores from capital gains deposit scheme and acquired a residential house property worth 2.5 crores. See, he deposited 3 crores, but how much is utilized? Utilized is only 2.5 crores. So before ITR due date, generally we will take amount deposited. But before ITR due date only, he has withdrawn 3 crores and utilized only 2.5 crores. So what we need to consider is not 3 crores. What we need to consider is 2.5 crores. So exemption under section 54 is equal to gross capital gain or reinvestment or 10 crores, whichever is lower. Gross capital gain 2 crores, reinvestment 2.5 crores or 10 crores, whichever is lower means 2 crores is eligible for exemption and net capital gain is nil. Are you able to understand? Is it clear? Next, jewelry. What would be the capital gain in hands of Mr. Arun for assessment year 25-26 if expenses in connection with the transfer of jewelry were 2 lakhs? So transfer expenses are 2 lakhs. Jewelry 3 crores. 300 lakhs. From that transfer expenses are 2 lakhs. So net consideration is 298 lakhs. Cost of acquisition is 2 crores. 2 crores means 200 lakhs. Now how much is gross capital gain? Gross capital gain is 98 lakhs. Capital asset transferred is jewelry. Jewelry means any capital asset other than residential house property. He reinvested 2.5 crores in residential house property, right? So any capital asset other than residential house property to residential house property. What is this combination? This combination is 54F combination. But how much is reinvested in new residential house property? 2 crore 50 lakhs. Out of 2.5 crores, 2 crores was claimed as 2 crores was claimed as exemption under section 54. So how much balance is left? 0.5 crore he can claim as exemption under section 54F. Am I correct or not? Exemption under section 54F. It will be calculated in 2 steps. Step 1, reinvestment or 10 crores, whichever is lower. How much is reinvested? 0.5 crore or 10 crore, whichever is lower. Point B, exemption is equal to gross capital gain into step 1 divided by net consideration. How much is gross capital gain? Gross capital gain is 98 lakhs. 98 lakhs into amount reinvested is only 50 lakhs. Kada? Only 0.5 crore means 50 lakhs. Net consideration is 298 lakhs. 50 lakhs divided by 298 lakhs. Calculate 98 lakhs into 50 divided by 298. So exemption is 16,44,295. This is exemption under section 54F. So how much is net capital gain? Net capital gain is 81,55,705 rupees. Whether that answer is there? Yes. 81,55,705 rupees. While deciding liability of an individual to deduct tax on payment of fees for professional services. Fees for professional services means 194J. Am I correct? Which of the following is immaterial? That means which is not required. We want amount paid to professional. See, if you want to deduct TDS under section 194J, you will check what is the amount paid to professional. If amount paid is less than threshold limit, less than 30,000, you are not required to deduct TDS. So we require amount paid to professional. Turnover of financial year. Yes, we also need turnover of financial year, because in preceding financial year, if turnover of individual is less than or equal to 1 crore, he is not required to deduct TDS. So turnover information is required. Turnover of immediately preceding financial year is required. Turnover of financial year in which payment is made. Whether current year turnover is required? No, current year turnover is not required. Last year, preceding financial year turnover is required. So current year turnover is not required. This is immaterial. So answer is C. Answer is C. Are you able to understand? Question 1, I will explain little later. Let us start doing question 2, 3 and 4. Okay. Question 2. Same type of problem I have explained in booster series. When I am explaining residential status, same type of problem I have explained. You can cross check also, YouTube video also available. Okay, this type of question is highly expected in the examination. Mrs. Smita, an Indian citizen in employment with overseas company located in UAE. She is not liable to tax in UAE. During 24-25, she comes to India for 121 days. So 24-25, she stayed in India for 120 days. I'm sorry, 121 days. She was in India for 50 days, 100 days, 76 days and 145 days in financial years 2021, 21, 22, 23, 24. So in 23, 24, she was in India for 145 days. In 22, 23, she was in India for 76 days. In 21, 22, she was in India for 100 days. In 2021, she was in India for 50 days. Okay. Salary accrued and arised in UAE. First of all, she is Indian citizen, but she is not staying in India. Indian citizen staying outside India and comes to India on a visit during current previous year. So she will fall under second exception to basic condition 2. If she falls under second exception to basic condition 2, what will we check? We will check total income minus income from foreign sources. Am I correct? Indian citizen staying outside India and comes to India during previous year on a visit. For her, what will we check? We will check total income minus income from foreign sources. So shall we check? See, what is income from foreign sources? How to calculate income from foreign sources? That is explained clearly in booster lecture. If you have any doubt with regard to classifying income from foreign sources, you can watch booster lecture. Okay. Salary accrued and arised in UAE. It is foreign income and it is also income from foreign sources. Income accrued and arised in India. It is Indian income. It is not income from foreign sources. Income deemed to be accrued in India. This is also Indian income and it is not income from foreign sources. Income arising and received in UAE from a business set up in India. So this is foreign income, but this is not income from foreign sources. So there is only one income from foreign sources, which is 15 lakh rupees. Income from foreign source is only one, which is 15 lakhs. Total income means how much? 15 lakh plus 2 lakh plus 7 lakh plus 5 lakhs. Total income is 29 lakhs. Income from foreign sources is 15 lakhs. So total income minus income from foreign sources is equal to 29 lakh minus 15 lakhs, which is equal to 14 lakhs. 14 lakhs means what? It is less than 15 lakhs. So total income minus foreign sources is less than 15 lakhs. If total income minus income from foreign sources is less than 15 lakhs, then only first basic condition is applicable. If B1 is satisfied, she will become resident in India. If B1 is not satisfied, don't apply B2 because basic condition 2 is not applicable in this case. So as per B1, individual should stay in India for 182 days. But she stayed in India for 121 days, which is less than 182 days. B1 not satisfied. So residential status is non-resident. So what is residential status of Smita? Smita is non-resident in India. In case of non-resident, only foreign income is taxable. So here foreign income is 15 lakhs and foreign income is 5 lakhs. So total income taxable to Smita is 15 lakhs plus 5 lakhs, 20 lakhs. Is it clear? You can also check the answer. One second, I am sorry. In case of non-resident, only Indian income is taxable, right? I am sorry. In case of non-resident, only Indian income is taxable. How much is Indian income? Only Indian income is taxable. How much is Indian income? This is Indian income and this is also Indian income. 2 lakh plus 7 lakhs. 9 lakhs is taxable for Smita. Are you able to understand? I'm sorry. In case of non-resident, only Indian income is taxable. Indian income is 2 lakhs plus 7 lakhs, 9 lakhs. Next, examine and explain TDS implications in following cases along with reasons thereof. Akash Private Limited pays following amounts to Mr. Santosh during previous year 24-25. 22,000 towards professional fees, 18,000 towards royalty. See, this is relating to section 194J. I have told you under section 194J there are 5 payments. What are they? Fees for professional services, fees for technical services, royalty, non-compete fees, director's remuneration. Out of 5 payments, for 4 payments, fees for professional service, technical services, royalty, non-compete fees. For each payment, separate threshold limit of 30,000 is applicable. So you should not combine. For Professional fees, separate 30,000 limit is available. For royalty, 30,000 limit is available. As 22,000 is less than 30,000 and 18,000 is also less than 30,000, no TDS is required to be deducted. Are you able to understand? Next. Payment of 1,75,000 made to Mr. Ankit for purchase of bag according to specifications of Merces Packaging Limited. Here, no material was supplied for such bag by Packaging Limited or its associates to Mr. Ankit. I told one example in the class. I went to tailor. I gave cloth. I gave measurements and I gave the specialization that is required by me. I told my shirt to be stitched in apple cut. I have told my specifications. As per requirements of my specification, using the cloth given by me, tailor stitched the cloth and gave it to me. It is works contract. Are you able to understand? Tailor purchased the cloth. He stitched the cloth in his own style. I liked that cloth. I purchased it. Now this is not works contract. It is a sale contract. Here also, as per my specifications, as per specifications of Packaging Limited, material was supplied. But whether Mr. Ankit gave any material, Ankit did not give any material. So it does not amount to works contract. Only using the material given by customer, if it is made as per specifications and gave it back, it amounts to works contract. Otherwise, it does not amount to works contract. In this case, it is not a works contract and no TDS is required to be deducted. Is it clear? See, no material was supplied. If material is supplied and using that material, if product is prepared and given, it amounts to works contract. However, material was not supplied, it does not amount to works contract, it amounts to sales contract. Next. Mr. Rishabh, a salaried employee in a private company, provides you with following information for the year ended 31st March 25. Basic salary 75,000 per month. From 1st February, basic salary increased to 85,000 per month. That means what? 1st February means 2 months. Let's say April to March. Starting from 1st February 25, salary increased to 85,000 per month. That means for 10 months salary is 75,000 per month. For 2 months salary is 85,000 per month. 75,000 into 10 months plus 85,000 into 2 months. How much? 75,000 into 10. 9,20,000. So basic salary is 9,20,000. 9,20,000 per annum. Dearness allowance 50% of basic salary. So how much is DA? 9,20,000 divided by 2. DA is equal to 4,60,000. 40% of DA forms part. That means DA forming part of retirement benefits. How much? 4,60,000 into 40%. 4,60,000 into 40%. How much? DA forming part of retirement benefits is 1,84,000. Very important. Read the question carefully. Contribution of employer to recognized provident fund account of employee 18% of basic salary. See, up to 12% of contribution exemption is allowed. What is salary definition for recognized provident fund? Salary is equal to basic plus DA forms part of retirement benefits. Up to 12% of contribution exempt, balance is taxable. Am I correct? So actual contribution is 18% of basic salary. Basic salary 9,20,000. 9,20,000 into 18%. How much? 1,65,600. Less how much is exempt? 12% contribution is exempt. Correct. Very careful. For the purpose of recognized provident fund, salary definition is basic plus DA forms part of retirement benefits. Basic is 9,20,000. DA forms part of retirement benefits is 1,84,000. So 9,20,000 plus 1,84,000 into 12%. How much? 1,32,480. Okay, how it was arrived? 9 lakh plus 1,84,000 into 12%. Is it clear? So how much is taxable? Taxable amount is minus 165,600, 33,120. Are you able to understand? Professional tax paid 2,200, 1 lakh 1,800 was paid by employer. So this is included in gross salary. Okay. House rent allowance 16,000 per month. He paid rent of 17,000 per month. So for HRA exemption is allowed, right? How do we calculate? There are 3 steps. HRA received how much? 16,000 per month. That means 16,000 into 12. 1,92,000. Less exemption. Under which section? Exemption is available under section 1013A. Step 1. Actual HRA received 1,92,000. Step 2. Rent paid minus 10% of salary. Rent paid is 17,000, right? 17,000 into 12, 2,04,000. Again, salary definition is basic plus DA. Basic 9,20,000, DA 1,84,000. 11,04,000 into 10%, 1,10,400. So 1,10,400 minus 2,04,000. It is equal to 93,600. Step 3. 40% of salary, because employee is working in Bangalore. In Bangalore, we need to take 40% of salary. So salary is basic plus DA forms part. 9,20,000 plus 1,84,000 into 40%. How much? 4,41,600. So out of these 3, whichever is lower. Whichever is lower means 93,600. So how much is taxable? 98,400 is taxable. Is it clear? Loan of 2 lakh was taken from employer on 1st July 24 for medical treatment of his brother for tuberculosis treatment. Interest charged on such loan is 5%. I think tuberculosis is specified disease. When loan is taken from employer for specified disease, interest rate benefit is not taxable. I think that is correct. Let us check. So since not a prerequisite, since loan is taken for medical treatment of his brother for tuberculosis. Tuberculosis is a specified disease. So when loan is taken for specified disease, interest rate benefit is not taxable to the employee. Next, leave travel concession given to Rishabh, his wife and 3 children. One daughter is aged 6 and twin sons aged 4. That means first birth single child, second birth multiple child. Okay, twins. In this case, benefit is available for all 3 children. I have told you, generally after 1st October 98, benefit is available for 2 children. However, if first child is single and second child is multiple children, benefit is available for all children. Am I correct? Good. Compute taxable salary of Mr. Rishabh if he has shifted out of default tax regime. You can see the calculation here. You can see the calculation here. I have explained very clearly. All the adjustments I have explained. Once go through the calculation. Next. Mr. Ravi, before we start reading the question, let us see whether it is default tax regime or optional tax regime. Because if we know whether it is default tax regime or optional tax regime, we can take decisions while reading the question itself. So in examination also, before you start reading the question, first go to the last sentence and read whether it is default tax regime or optional tax regime. Is it clear? Here, compute total income of Ravi under default tax regime. When you are calculating under default tax regime, certain benefits are not available. Okay. Ravi, resident in India, owns two house properties, one in Delhi, another in Kanpur. So Ravi has two house properties. House property 1, Delhi. House property 2, Kanpur. Property in Kanpur is self-occupied by Mr. Ravi. However, property in Delhi is let out. So Kanpur house property is self-occupied. Delhi house property is let out. My dear students, please remember, in case of default tax rates, if there is any interest on self-occupied property, interest on self-occupied property is not allowed as deduction under section 24B under the head house property if SSE is paying taxes under default tax rates. Correct? Careful, remember it. The particulars of Delhi house. Delhi house means let out property. Standard rent, municipal rent, fair rent. Fair rent or municipal rent, whichever is higher means 2,05,000. Municipal rent or standard rent, whichever is lower means 1,72,000. So expected rent is 1,72,000. How much is actual rent? Actual rent is 15,000 per month. 15,000 into 12, 1,80,000. Here actual rent is greater than expected rent. So gross annual value is equal to actual rent. Am I correct or not? So gross annual value is equal to actual rent is equal to 1,80,000. Good. Municipal tax paid by Ravi on 10th June 24 for Kanpur house. Kanpur house is self-occupied property. In case of self-occupied property, whether municipal taxes are allowed, for self-occupied property, municipal taxes are not allowed as deduction. Mr. Ravi had taken loan from SBI of 35 lakhs at the rate of 12% per annum in April 2021 for purchase of Delhi house. Delhi house is let out property. In case of let out property, interest is allowed even under default tax regime. But if loan is taken for self-occupied property, interest is not allowed under section 24B. Correct? Now, the stamp duty value of this house is 40 lakhs. Mr. Ravi purchased a plot in Kanpur in May 21. Hold on. Delhi house, when loan was taken in 21-22. When Delhi house was constructed, that is not given, we will see. Mr. Ravi purchased a plot in Kanpur. Kanpur is self-occupied property, right? And the construction of Kanpur house began in June 2021 and was completed on December 2022. Mr. Ravi took loan of 25 lakhs at the rate of 10% for construction of this house. See, Kanpur house, it is self-occupied property. Interest is not allowed as deduction. Very, very clear. For Kanpur house, interest is not allowed because it is self-occupied property and SSE is paying taxes under default tax rates. Is it clear? Now, Delhi house let out property, right? For let out property, interest is allowed as deduction. So, what is the amount of loan taken? 35 lakhs. Rate of interest 12% per annum. So how much is current year interest? Current year interest is equal to 35 lakhs into 12%. How much? 4,20,000 is current year interest. Correct? Good. So with regard to Delhi house property, municipal taxes are paid. Municipal taxes are 5% of municipal valuation. Municipal valuation is 2,05,000 per annum. Correct? Now, less municipal taxes. Municipal taxes is equal to 2,05,000, right? 2,05,000 into 5%. How much? 10,250. How much is net annual value? Net annual value is equal to 1,69,750 less deductions under section 24. First one is standard deduction. It is allowed at the rate of 30% of net annual value. 30% means 50,925. Second, interest on borrowed capital. How much is interest on borrowed capital? 4,20,000. We have calculated. So there is loss from let out property. How much is loss from let out property? 3,01,175. He is also having income from salary 18 lakhs. He earned salary income. See, from gross salary deduction is allowed, right? Gross salary is 18 lakhs. Standard deduction 75,000 available under default tax rates. So net salary is 17,25,000. First of all, under default tax rates, loss from house property cannot be set off against any other head of income. So his total income will be 17,25,000. Is it clear? Did you understand? I think the answer is correct. Let us see. You can see 3,01,175. Final answer is 17,25,000. Next, fourth one. Mr. Gagan, a classical singer of Bengal, and his wife Mrs. Reshmi furnished the following information relating to assessment year 25-26. Income of Gagan, professional classical singer. This is taxable under PGBP. Salary income computed means what? After claiming standard deduction. Whenever computed is given, it means after standard deduction net salary income. Okay. 3,80,000. This is taxable under salaries. Loan received by Mrs. Reshmi from XYZ Private Limited. Mrs. Reshmi holds 35%. That means Reshmi is having substantial interest. The company has incurred losses since its inception. That means what? There is deemed dividend concept. If loan is given to equity shareholder having more than or equal to 10% of staking, beneficial owner. If any loan is given by private limited company to beneficial owner, such loan is taxable in the hands of shareholder as deemed dividend to the extent of accumulated profits. Here from last 2 years there are losses, there are no accumulated profits. So even though loan is given, this is not a deemed dividend. If it is not a deemed dividend, it is not going to get taxed. Is it clear? Income of their minor son from winning singing reality show. See, this is based upon skill, right? So that is taxable in hands of minor only. Taxable for minor. In the hands of minor only it is taxable. Cash gift received by Gaurav from friend of Gagan on winning the show. Cash gift is 21,000 less than 50,000. So this is not taxable. Interest income received by minor married daughter. See, major confusion is there. In case of minor married daughter, income will be clubbed in the hands of parents. Another important thing, deemed ownership concept is there, section 27. As per deemed ownership concept, if house property is transferred to minor married daughter, deemed ownership concept is not applicable, because like it is specifically excluded from deemed ownership concept. In that case also, house property rental income received by minor married daughter is clubbed in the hands of parents whose total income is higher. However, at the time of clubbing, you can claim 1500 exemption. Is it clear? So 40,000 minus 1500, 38,500. 38,500. Whose income is higher? Gagan income or Reshmi income? Out of these two, whichever is higher means Gagan income is higher. So in the hands of Gagan, 38,500 will be clubbed. Is it clear? Next, Mr. Vijay, Indian citizen residing in Chennai, files his return of income every year on time. He has Aadhaar number as well. He has not intimated his Aadhaar number to the prescribed authority till August 2024. See, if Aadhaar number is not intimated, if Aadhaar number is not linked with PAN, then there are certain consequences. What are those consequences? If Vijay is eligible for refund, refund will not be issued to him. Not only refund, interest on refund will also be not given to Vijay. And if PAN is inoperative, if you do not link your Aadhaar number with PAN, PAN will become inoperative. When PAN becomes inoperative, if someone are paying you TDS, they are going to deduct TDS at higher rate. And if TCS is required to be collected for you, higher rate of TCS will be collected as PAN is inoperative. And as per 234H, you need to link your PAN number with Aadhaar number. But for that linking PAN number with Aadhaar number, under 234H, 1000 rupees penalty is required to be payable. Is it clear? In each of the following independent situations, you are required to examine whether these persons are required to file return of income or not. Turnover of Ankit business is 65 lakhs. It is greater than 60 lakhs. So income tax return is required to be filed. Next, Mr. Suyash has incurred total expenditure of 90,000 towards consumption of electricity. Electricity bill is less than 1 lakh. So ITR is not required to be filed. I told you, only if electricity bill is more than 1 lakh per annum, then only ITR is required to be filed. Here, electricity bill is less than 1 lakh. So ITR is not required to be filed. Now let us see question number 1. Mr. Brajesh has set up unit in SEZ in May 2017. May 2017 means previous year 17-18. The total turnover, export turnover and net profit for the year ended were 120 lakhs, 45 lakhs, net profit 7.5 lakhs respectively. Out of export turnover of 45 lakhs, only 40 lakhs has been received in convertible foreign exchange. That means only 40 lakhs will be taken while calculating deduction under section 10AA. Okay. During 24-25, Brajesh has commenced a business of warehousing facility for storage of food grain. So this is specified business eligible for deduction under section 35 AD. Am I correct? The net profit of business as per P&L account is 8,50,000. The following items are debited to P&L account. Whether personal drawings are to be debited, that is not allowed as deduction, that is to be disallowed. Advance income tax. Income tax is also not allowed as deduction, so we need to disallow income tax also. Purchase of warehouse building for 10 lakhs on 10th June 2024 for the purpose of storage of food grain. See, for specified business, 100% of the capital expenditure is allowed as deduction, so you can claim the deduction. Following items were credited to P&L account. Interest on savings bank, this is taxable under IFOS, that should not be credited to P&L account. Interest on FD, that is also taxable under other sources, should not be credited to P&L account. Dividend from Indian companies, that is also taxable under other sources and it should not be credited to P&L account. So we will disallow while calculating PGBP. Brajesh is also working partner in Mercer's Neil Kamal Associates, a partnership firm. Brajesh has contributed 15 lakhs as a capital in the firm. Further, partnership deed authorizes payment of interest to partners 13%. Whether 13% is allowed, out of 13%, 12% is allowed, 1% is disallowed, because as per provisions of PGBP section 40B, maximum interest allowed as deduction to partner is 12% under PGBP, correct? Whole of the remuneration is allowable as deduction to Neil Kamal Associates. See, whatever the remuneration allowed as expenditure to partnership firm is there, same amount is considered as income in the hands of partners, and such income is taxable under the head PGBP. Is it clear? Brajesh also paid premium of 60,000 on life insurance policy. This is eligible for deduction under section 80C. Sum assured is 5 lakhs. So actual life insurance premium or 10% of sum assured, whichever is lower. Actual life insurance premium 60,000. 10% of sum assured means 5 lakh into 10% 50,000. Whichever is lower means 50,000 is allowed as deduction under section 80C. Is it clear? Compute total income and tax payable by Brajesh under default and normal provisions. Super. First, let us calculate tax liability under default tax regime. First of all, please listen. Under default tax regime, 35AD deduction is not allowed. Section 10AA deduction is also not allowed. Be careful. Don't claim deduction under section 35AD. Don't claim deduction under section 10AA for default tax regime, because under default tax regime, these two are not allowed as deduction. Is it clear? So, shall we calculate the income? So, under default tax regime, total income under default tax regime. How much is net profit from cess business? Net profit from cess business is 7,50,000. Don't claim deduction under section 10AA. Deduction under section 10AA is not allowed. Next, net profit from specified business. For specified business, whether deduction is allowed, deduction under section 35AD is not allowed. So how much is net profit? Net profit is net profit as per accounts is net profit as per accounts 8,50,000. Net profit as per accounts 8,50,000. So we will add back. Disallowed expenses are to be added back, right? Drawings to be added back, advance income tax to be added back, purchase of warehouse building. If we are claiming deduction under section 35AD, 100% capital expenditure we would have claimed. But under default tax regime, 35AD deduction is not allowed. So we will add back drawings. We will also add back income tax. We will also add back purchase of warehouse. How much? 70,000, 1 lakh, 10 lakhs. However, we can claim depreciation on building, right? On building, what is the rate of depreciation? 10%. 10 lakhs into 10%. 1 lakh is allowed as deduction. Okay. Similarly, incomes taxable under other sources, they should not be credited to P&L account. What are they? Interest on SB 15,000, FD 20,000. So that should not be credited to P&L account. So what we will do? We will disallow, because they are taxable under other sources. Dividend from Indian companies 32,000. So how much is PGBP income? 8,50,000 plus 70,000 plus 11 lakh minus 1 lakh minus 15,000 minus 20,000 minus 32,000. 18,53,000. Next. He is getting remuneration from partnership firm, right? How much? 20,000 per month. So remuneration 2,40,000. 20,000 into 12. Next. Interest on partners only 12% is allowed. Whatever interest allowed to partnership firm is there, same is considered as income in the hands of partners and is taxable under PGBP. So interest is equal to 15 lakhs into 12%. I think 1,80,000. I think. Let me check. 1,80,000. So how much is total income, gross total income? 7,50,000 plus 18,53,000 plus 2,40,000 plus 1,80,000. 30,23,000. Chapter 6A deductions are not allowed under default tax regime. So net total income is 30,23,000. Okay. Let me check whether it is correct or not. Okay. I am sorry. Here dividend is where it went wrong. 18,53,000 correct. 4,20,000 correct. Yes, interest on savings bank account from post office. So eligible for 1,500 exemption. Correct. 7,50,000 was taxed. 18,53,000 was also taxed. Okay, the mistake we did is we considered only PGBP income. We need to consider income from other sources. How much is income from other sources? Savings bank 15,000 minus 1,500. How much? 13,500. FD 20,000. Dividend 32,000. So how much is income from other sources? 32,000 plus 20,000 plus 13,500. 65,500. So 65,500 plus 1,80,000 plus 2,40,000 plus 18,53,000 plus 7,50,000. Hold on. Here exemption is 3,500, right? That means 11,500. That means 63,500. Total income is, gross total income is 30,86,500. Chapter 6A deductions are not allowed. Net total income is 30,86,500. Under default tax regime, you know the tax rates, right? Up to 3 lakhs nil, greater than 3 lakh up to 7 lakh 5%, above 7 lakh up to 10 lakh 10%, above 10 lakh up to 12 lakh 15%, above 12 lakh up to 15 lakh 20%, above 15 lakh 30% tax rate is applicable. And here total income is less than 50 lakhs. So surcharge is not applicable. You can calculate final tax liability. Okay. So 30,86,500 is total income and final tax liability is 5,40,590. Okay. This tax calculation you please go through. You can do on your own. So I am not doing the tax calculation. Now we need to calculate tax liability under normal tax rates. Normal tax rates means optional tax regime, OTR, optional tax regime. See, whenever deduction under section 35 AD is claimed, whenever deduction under section 10 AA is claimed, alternate minimum tax provisions are applicable. So we need to calculate tax liability as per normal provisions. We also need to calculate alternate minimum tax, whichever is higher, that is required to be paid to the government. Is it clear? So first let us calculate total income. Cess profit. How much is cess profit? 7,50,000. Correct. Deduction is allowed. Less deduction under section 10AA. When business was started in May 2017. That means business was started in 1718. 1718 first year, 1819 second year, 1920 third year, 2021 fourth year, 2122 fifth year, 2223 sixth year, 2324 seventh year, 2425 eighth year. So for eighth year, how much deduction is allowed? 50% of export profits are allowed as deduction. 50% of export profits. Export profit is equal to net profit into export turnover divided by total turnover. Correct. Now how much is net profit? 7.5 lakhs. How much is export turnover? Export turnover is only 40 lakhs because 40 lakhs was converted into foreign exchange. Correct. So 40 lakhs divided by total turnover. How much is total turnover? Total turnover is 120 lakhs. 7,50,000 into 40 by 120. How much? 2,50,000. 2,50,000 into 50%. Very important. Why only 50% of export profits are allowed as deduction? So deduction is 1,25,000. Net taxable will be 6,25,000. Is it clear? Next. PGBP income. First, specified business. Under normal provisions, for specified business, you can claim deduction under section 35 AD, right? So, how much is net profit as per accounts? Net profit as per accounts is equal to 8,50,000. We need to add back drawings. How much are drawings? Drawings 70,000. Income tax 1 lakh. Purchase of building, I am not adding back because under optional tax regime, you can claim deduction under section 35 AD. You can claim capital expenditure also deduction. So 10 lakhs is allowable expenditure. You need not disallow it. Okay. Next, this is allowed as deduction under optional tax rates. Next, we need to reduce. How much is interest on savings bank? Less. Incomes taxable under other sources. Savings bank interest is 15,000. Am I correct? That will be reduced. Next, FD interest is 20,000. That is also reduced. Why? Because it is now taxable under PGBP. It is taxable under other sources. Dividend will also be reduced. 32,000. So after reducing all these, how much is income? 8,50,000 plus 70,000 plus 1 lakh minus 15,000 minus 20,000 minus 32,000. 9,53,000. Next, remuneration 2,40,000. Interest on partners capital at the rate of 12%, 1,80,000. Now how much is incomes taxable under other sources? Savings bank, it is received from post office. 15,000 minus 3,500. How much? 11,500. FD 20,000. Dividend 32,000. Total 32,000 plus 20,000 plus 11,500. 63,500. So how much is gross total income? Gross total income is 6,25,000 plus 9,53,000 plus 2,40,000 plus 1,80,000 plus 63,500. 20,61,500. From this we will reduce Chapter 6A deductions. ATC, LIC premium was paid, right? How much LIC premium was paid? 60,000. Even though 60,000 is paid, 5 lakh into 10%, 50,000 is allowed as deduction. ATC 50,000. So how much is total income? Total income is 20 lakh 11,500. Let us check with the answer whether answer is correct or not. Total income. Yeah, interest on savings bank 10,000 deduction is available, right? So 80 TTA 10,000. So total income is 20 lakh 1,500. Under optional tax rates, you know, up to 2,50,000 nil, greater than 2,50,000 up to 5 lakh 5%, above 5 lakh up to 10 lakh 20%, above 10 lakh tax rate applicable is 30%, correct? Using those tax rates, calculate tax liability. How much is tax liability? Tax liability is 3,29,470, correct? Tax liability 329,470. You can go through the tax calculation. However, AMT provisions are also applicable under optional tax regime. AMT tax provisions are also applicable. AMT is equal to adjusted total income into 18.5% plus applicable surcharge plus HEC at the rate of 4%. Now what we need to calculate? We need to calculate adjusted total income. How to calculate adjusted total income? Let's take total income as per normal provisions. Total income as per normal provisions is equal to 20 lakh 1,500. We need to add back deduction under section 10AA. How much is deduction under section 10AA? 1,25,000. So add back 1,25,000. We also need to add back deduction under section 35 AD. How much is deduction under section 35 AD? 10 lakhs. For building, we have claimed 10 lakhs as deduction, right? 100% of capex. From this, we need to reduce depreciation for building. Depreciation for building is 1 lakh. So after you reduce this, you will arrive at adjusted total income. How much is adjusted total income? 20 lakh 1,500 plus 1 lakh 25,000 plus 10 lakh minus 1 lakh. 30 lakh 36,500. AMT is equal to 30 lakh 36,500 into 18.5%. How much? 5,61,750 rupees. Am I correct? So to this we need to add HEC. How much is HEC at the rate of 4%? 22,470. So how much is alternate minimum tax? Alternate minimum tax is equal to 561,750 minus 22,470. 539,280. So alternate minimum tax is equal to adjusted total income 30 lakh. Wait. Did I do calculation wrong? 20 lakh 1,500 plus 1 lakh 25,000 plus 10 lakh minus 1 lakh. 30 lakh 26,500. This is not 36. 30 lakh 26,500. I did calculation mistake. So please rectify 30 lakh 26,500 into 18.5%. How much? 5 lakh 59,902.5 into 4%. HEC 22,396. 559,902.36 or 5 plus 22,396. 582,298. That means rounded off to 582,300. So alternate minimum tax is 582,300. Advance tax paid is 1 lakh. Which is higher? Alternate minimum tax 582,300. Regular tax. How much is regular tax? Regular tax is 329,470. Out of these two, whichever is higher means alternate minimum tax is higher. So we need to pay 580 to 300. But advance tax was paid. How much is advance tax? 1 lakh. After reducing 1 lakh advance tax, balance 4,82,300 is required to be paid. How much is AMT credit? AMT credit is equal to difference between AMT and regular tax. AMT 582 300, regular tax is 329 470. So AMT credit is equal to 582 300 minus 329 470. 252 830 is AMT credit. Okay, so this is comprehensive detailed explanation of MTP1. Thank you very much. So if you like this explanation, please share with your friends as well. Okay, only if you like. Thank you very much. Bye.